Hello, and welcome to Credit Matters, the podcast where credit absolutely matters. I'm Shankar Ramakrishnan, your host and head of US Credit and Global Market Engagement at IGM. I'm here with my colleague and co host, Bruce Clark.
Morning, buddy. How are we?
Morning, sir. Head of Rates Market Coverage at IGM. So, today we are going to talk about a very private market that deals with selling the risk of losses on loans made by banks through structured notes that are sold to investors without actually selling the underlying loans. Yes, it's very complicated. They're called by different names too, to add to the complication. In the US, they can be called credit risk transfers or credit risk sharing or CRTs or CRS. Or in Europe, they are more known as significant or synthetic risk transfers or SRTs. We'll also talk about bank regulations under the new administration, what changes we can expect under a new central bank policy. These critical questions will be addressed by Matt Bisanz.
I love it.
Welcome, Matt. Welcome.
Thank you.
That's
Thank
a
you.
trademark welcome nowadays.
It's awesome. You guys are great.
So, Matt is a partner at law firm Mayer Brown's financial regulatory practice, and he counsels domestic and global financial services firms on a variety of banking and derivatives regulatory issues. He played a central role in the development of the credit risk transfer market. He previously worked at the SEC, CFTC, DOJ, and FDIC in various regulatory and investigative roles, and at a Big Four accounting firm in New York. That's amazing, Matt. That's amazing. I didn't know you were with all the regulators as well before this.
Yeah. And I'm only 19 years old as well. So.
You do look more like one. So I can kick it off with what since this is your expertise, I want to know how are regulations looking for the financial sector, especially after the regional banking crisis. And could you also take us through like what actually caused the regional banking crisis and how we have changed since then?
Sure. And so I think that what I find interesting is that the immediate regulatory response to the regional banking crisis really did not address what I see as some of the key factors in it. The most immediate response was the original Basel III proposal, and that had almost nothing to do with it. That none of the banks who failed during the crisis failed because of a lack of capital.
Right.
That they had other issues, and so I was kind of surprised to see that as the thing of focus, because it really didn't make sense given what my perspective was on the failures. For me, the failures went to I don't want to say resilience even, but they went to preparedness. That the discount window functions really are an antiquated way of doing business with the Fed to manage crises.
Right.
And so when we had these crises occur, you had situations where, the San Francisco Fed had to stay open till midnight to try to get transactions processed, or you were trying to shift collateral from a custodian or depledge or repledge it. And,
Right.
you had the FLIB timing versus the Fed timing. And so all of these things,
Right.
like if you sat down with a reasonable person and said, hey, my house is on fire, I need to get the fire department here to put it out, like you would quickly throw out many of these artificial constraints and find a better way to
Right.
do things. And so I think that overhauling the discount window, overhauling things like collateral eligibility at the discount window, better indexing a bank's liquidity capacity based on its discount window borrowing capacity,
Right.
again, the LCR and the NSFR until recently did not take into account a bank's borrowing capacity, even though in a stress event, really the lender of last resort would be the source of liquidity.
Right.
So those are the kind of areas where I was expecting to see more regulation or changed regulation after the regional banking crisis.
Right. But that didn't happen, do you think, or they're moving towards it, or what's the status on that?
So that did not happen. I think that there is a movement toward it, that the Fed has signaled that in, I guess, next year, probably it will be looking at these liquidity regulations.
Right.
They had to first, I think, get the capital ones because they had this proposal sitting out there that didn't make a lot of sense.
Right.
And so they kind of had to fix, like, wrap that up, and hopefully we will get that wrapped up around the end of this year.
Right.
But again, like, I think that next year we will be talking a lot about liquidity and discount window operations.
So do you think the if the problems around the crisis were not addressed or not fully addressed, do you think we run a risk of having a similar situation in what is the market, which is
I
very
think that banks have, in large extent, adjusted their behavior
right.
to account for these failures, and so banks are trying to manage themselves so that they are fixing the system until kind of the government fixes the structure.
Like one of the things which I kind of look at the regional banking crisis was if it was a capital problem, do you think we still have a capital problem in a market where everyone has got access to debt and able to refinance and move things around?
So I don't think we have a capital problem in the system. I think banks are extraordinarily well capitalized,
Right.
and banks can not only raise capital to the extent they need to, they also, again, have a great baseline of capital to absorb losses from their current books, and then also go to the discount window or other emergency liquidity sources. So
Right.
I'm not particularly worried about capital.
Okay. Okay.
Yeah, Matt, the new incoming Fed has created 5 different areas, task force of different areas to look at. And regulation, I'm looking at it now: communications, balance sheet, data, productivity, and inflation. I don't see regulation on any of those working groups. Does that concern you that this sort of got pushed to the background or not a priority?
Not really, because I think that from the perspective of the new Fed, regulation is one of the things they have a lot of confidence in. That we have great leadership in the vice chair for supervision. That after the 2008 financial crisis, that role was institutionalized, made subject to Senate confirmation. And we have a great leader in that role right now, someone who's
Right.
been at the Fed for a long time. And so I think from the perspective of the Fed structure, that is one of the areas they view as working well right now. The other areas that are covered by those task forces are, I think, the areas where there's some question or concerns with
Right.
the way the system is working.
So no need for a working group is a vote of confidence, in
Yes.
fact, in the regulatory.
Yes,
Gotcha.
exactly.
Okay.
Right. And like Matt, after the regional banking crisis, almost the markets are like they were unsecured depositors who were bailed out, right? Like, which is kind of why are you called unsecured?
Yeah.
Can
Well,
we?
uninsured depositors. Yeah, the
Yeah.
uninsured depositors were the ones who, yeah. And look, that's a whole concept of like the Great Depression market discipline,
Right.
that we do have. If you're someone who has a lot of money at a bank, you're uninsured, and in the current economy we live, there will always be people who have uninsured deposits. That if
Right.
you are, a Fortune 500 company, there's no way you can run with the cash balances. Even if you use deposit placement networks, there's no way you could run your cash balances within the deposit insurance limits.
Right.
And so there is this kind of uncomfortableness that we have an economy structured where we have to have people who hold massive amounts of money in bank deposit accounts.
Right.
But we also, as a governance, a societal matter, we're not exactly comfortable with either the banking sector because they're the ones who pay the deposit insurance
Right.
assessments, or the government because they're the backstop to the deposit insurance fund, being on the hook. And so I don't think that the current, again, leadership of the Fed or the FDIC is of the view that uninsured depositors will always be bailed out. That
Right.
there is a market discipline perspective on things that should corporates out there, your big corporates, be prudently managing their cash by
Right.
having some in treasuries, by having some in banks, by having some in money funds. Like yes, that if you're a big corporate, like, you don't want all of your liquid assets sitting in a cash account at a single bank.
Right.
Is there also a concentration risk that people should be aware of? That, if you're a big corporate and your deposits are 30% of a bank's balance sheet,
Right.
you may not know it. It's regulatory ratings. It's you shouldn't know it's Camel's rating, but should you know that, hey, maybe that I'm a bit too big of a relationship for this bank, that they're not really built for someone of my size, that kind of like that saying of when you owe $100 to a bank, you have a problem. When you owe $1 billion to a
Yeah,
bank, they have a
exactly.
problem. And so when a bank owes you 30% of its balance sheet, maybe you have the problem more than the bank does.
So do you think um, when uninsured depositors, I guess the policy changes a bit, but it almost created this I don't want to use the word bubble, but it's almost created this whole frenzy of buying assets and riskier assets, where people think there is someone behind or ensuring the lowest end of the market, like there is someone, the lender of last resort kind of thing. Do
Well,
you
I would
think
split. Yeah,
that's part of it?
I would split out the two concepts you're talking about there. So, on
Right.
one hand, you have corporates who have their liquid cash.
Right.
And I think for the most part, they have been shifting from having uninsured deposits to another type of cash management. So they're putting it into treasuries, they're putting it into money market mutual funds, they're using deposit placement networks, they're shifting their cash into safe assets.
Right.
On the other side, I think what you're alluding to is you have other users of long-term money. So
Right.
people like insurance companies, pension plans, sovereign wealth funds, similar types of long-term investors who are seeking things like private credit investments,
Right.
synthetic risk transfers, things like that, because for them it's not about the riskiness of their liquid cash. It's
Right.
about the yield they're earning on their long-term investments. And so that's why I would kind of split it into two concepts. And I really think that, at least on the corporate side, and probably on the long-term side, but on the corporate side, their reallocation of liquid assets has been pretty responsible so far.
Right. Right.
Has the conversation amongst your clients crossed your desk about this new change at the Fed is is potentially going to be less likely or less reactive to events like Silicon Valley Bank, for example, where the Fed stepped in within 24 hours and through a say, and the message for that, as a trader, the message was the Fed continues to operate a safety net under the markets. I mean, the signal that sent. Do you sense that changing with this new Fed? Like there's not going to be a safety net, or if there is, it's going to be a lot lower than it was before.
I think and I don't know it's the message of the current Fed or even the intended message of the 2023 Fed, but the message I think the Fed wants to send is we will be a safety net for the real economy, the Main Street economy, the making sure people can cover payroll. That was one of the big issues with the 2023 banking crisis, is that some of the uninsured depositors were things like payroll companies.
Right.
I don't think the Fed has much appetite or interest in supporting the market in the sense of keeping stock prices high or keeping asset prices high for the private equity funds. That the Fed really is focused on maintaining financial stability for the economy writ large, as it
Right.
affects people like you and me, and blue collar workers, and like the legions of service professionals across the country, more so than it's concerned with it maintaining the headlines for the stock market.
Right. Yeah. I mean, that's the message. Just in the last couple of months, is that there may be a Fed put, but the strike price is quite a bit lower than it was with previous Fed governance.
Yeah, but Matt, do you see a rise in financial engineering in this market? So, with all that in the backdrop, do you see people taking on way more risk or playing, different structures? Some of them used before the subprime crisis. How do you see that? Like, is that a riskier thing for the market?
I don't really see a ton of financial engineering going on right now. I see it more as efficient allocation of risks that people, particularly after the inflation cycle that started in 2021, people are realizing that we are in a dynamic economy, and that risk is present in many shapes, not just credit risk, but also liquidity risk, like the 2023 banking crisis, or interest rate or price risk, like from inflation. That we have the geopolitical risk that influences pricing of things in the real economy. And so people are saying, look, we're not in this zero interest rate world where we can ignore some of these risks because just the marginal difference is so small, that now we do need to deploy efficient structures to better manage our resources. And so that's where I think some of these innovations that you're alluding to come from that desire.
Right. But they, and some of these structures, like I've noticed in the high yield markets, right, like where there are drop downs, double dips, structures which kind of delay bankruptcies, and they're nudged on by the law firms.
Yeah.
So and it's kind of complicating the whole situation. It's like a war of legalese now going on in these markets. What do you think of the role of law firms in all this? And what is the risk they are creating with too much involvement, you think?
So I don't think there's a lot of risk here, and I think you might be alluding to things like liability management exercises,
liability management, yeah.
which are a bit outside my zone of expertise.
Right.
I'll say that some of my partners who work more on them, because that tends to be more of a corporate on corporate or investment fund on corporate sector, that you don't see as many banks partaking in liability management exercises. I think if anything that is a message to lawyers that we need to do better. That a lot of these liability management exercises take advantage of gaps in drafting, and I won't say they're mistakes that were made, because I think we all knew what was there, but maybe people didn't focus again on the risk that in 2015, looking at the risks of a drop down sub maybe didn't seem as apparent, and so now people are more attuned that these risks exist, and that lawyers need to be to kind of be detailed in the way they draft
Right.
the loans to address these risks.
Right. Right. But talking about risks, I wanted to talk to you about credit risk transfers.
Yes, yes.
So let's start from the beginning. What are these structures and who uses them?
Yeah. So I'll start first with these are used by banks, and they address what is really a problem that I'll call is an accounting problem in large part. So when a bank makes a loan, it has an asset on its balance sheet. And that's like we'll use my 30-year mortgage, which I got at a really good 2.5% interest rate. I know everyone's jealous at me. And that mortgage is a 30-year asset on the bank's balance sheet. And that mortgage was made, we'll say, in like 2021, just to make up a number.
Right.
And that mortgage, I'm still paying it. I've made every payment on it. Absent something unexpected happening, I should make all of my repayments on it. I have a beautiful house that collateralizes it. So even if I didn't make the payments, the bank should be able to sell the house and get the money, that it has a great loan to value ratio. So from a credit risk perspective, there's almost no risk, but there is very low risk to the bank of losing money.
Right.
So when you're valuing it, the bank rightly on its balance sheet puts it at face value of the amount I owe it. But in the market, it isn't valued that way, because in today's market, if you wanted a low risk investment, you could get much better than a 2.5% rate of return. That even if I, as a good credit risk, was going to go out and get a mortgage today, I'd probably be paying something close to 7%. And so from the market's perspective, that loan on the bank's balance sheet is worth a lot less than face value. And if the bank were to go into the market and say, hey, who wants to buy Matt's mortgage from me?
Right.
They would have to take a big haircut on it. Right. And so when a bank is looking at their capital requirements, they're saying, I'm holding capital, at against Matt's mortgage at a 50% risk weight, which is the same risk weight as every other mortgage on my balance sheet. Some are more risky than others. Some are better collateralized or whatever, but I'm holding against them at a 50% risk weight because that's what the capital rules say. And I might like to sell it and replace it with a better asset, or I might like to securitize it, but I can't, because if I do that, I have to sell it at a loss to reflect the changing interest rates.
Interesting.
And so I'm kind of stuck between this rock and a hard place where I'm holding more capital than I need based on the credit risk presented by Matt, but also I can't move it because I don't want to take a loss, a mark-to-market loss.
Right.
And so synthetic risk transfer, credit risk transfer says, well, let's solve that by leaving the asset on the bank's balance sheet.
Right.
So we don't have to recognize the mark-to-market loss, but we're going to transfer the credit risk, Matt's very low credit risk, to another investor. And that investor will tell the bank, hey, I will take on a portion of Matt's credit risk. And that investor will provide additional security. And so from the regulator's perspective, there now is a person who's going to lose ahead of the bank. There's a first loss investor. And that means that we kind of have created a securitization that lets the bank take a lower risk weight on the loan exposure to me.
Right. And that allows them to put lesser capital against those assets. Yeah.
Right, because they're saying, look, now I'm in a second loss position on Matt's mortgage, so my already low likelihood of losses is even lower now, and so I should be allowed to treat it as if I securitized Matt's mortgage and took a senior tranche of that securitization.
So that sounds like easy peasy, no? Or is it not?
I wouldn't have a job if it was easy. I wouldn't have a job. Look, this is besides just the intricate accounting and capital rules interplay here. There also is the fact that these things weren't really done much after the 2008 financial crisis. That things like credit default swaps got a bad name, and so the technology didn't really develop for several years. There's things like the market is still wildly inefficient in how it handles debt securities versus things like swaps, and so you end up with some legal inefficiencies there that you have to design around. You have the fact that while we call this protection being provided by an investor, we don't want it regulated like insurance because it's not really insurance. It's not insuring against a risk of loss. It's insuring against a reference pool. We're not actually transferring the instrument. And so we have the interplay with insurance regulation. And so it ends up being pretty complicated to thread all of those different regulatory regimes in an efficient manner for the clients.
And for the bank as well, they have to coordinate with different departments to get these assets together, right? From what you're saying, the assets in itself are high quality mostly, or do you see?
Mostly, yes. Yeah, because you're looking for, as I call it, a mismatch where the amount of capital the regulators make you hold against an asset is higher than the actual capital based on the risk of loss. And so if you have very high quality assets like residential mortgage loans, like sublines, like prime auto, you're going to find that the discrepancy between the risk weights that are assigned to those assets and the actual credit risk is quite dramatic. And from an investor's perspective as well, that's good for them because they're getting a reasonable return by providing protection on this high quality pool. And so they're kind of sharing in that benefit with the bank.
So Matt, using your example, the bank doesn't just apply this credit risk transfer to Matt Bisanz's mortgage. They're pooled, obviously, right? Similar credit scales, I suppose. And how is that priced? And what is a credit risk transfer? What kind of return could I expect versus other instruments? I mean, where does it trade? Does it trade on a spread to treasuries, or how does that trade?
Yeah, well, thankfully it doesn't trade too much. I know you're a former trader, but thankfully it doesn't trade too much because from the bank's perspective, they're looking for protection. They're not looking to create a new traded instrument in the market. Okay. And it does depend on the underlying asset. It also depends on the kind of quality of the bank. That, if you have a GSIB out there with sublines that they're doing, you might see spreads like SOFR plus 200. Just to give you a perspective. If you see a more concentrated regional bank that's doing maybe a more iffy pool of commercial real estate loans, you might see SOFR plus 1,500. So pretty wide spreads depending. And from the investor's perspective, they are taking concentrated risk. They're taking first loss risk, and that's typically 15% first loss risk is the typical market standard. And so from their perspective, even on my 2.5% mortgage, they're going to charge more than a 2.5% rate of return because they're taking the first loss piece on it. And that's why you can get up to the 1500s for commercial real estate, even if the underlying borrowers are nowhere near that rate of interest, because again, they're taking first loss on commercial real estate. So the markets, the spreads are very indicative of the underlying asset quality.
And what are the maturities on these? I've heard 3 years. Is it 5 years as well, or is it just short term?
So the capital regulations incentivize banks to match the maturity to the underlying reference pool. that you don't want a maturity mismatch where, again, using my 25-year mortgage, let's say the bank, like I have 25 years left on my mortgage. If the bank buys a protection for 20 years, then there's this 5-year period at the end where the bank isn't protected. Right. And so the capital rules penalize banks if they have that kind of maturity mismatch. Most of the risk transfers that have been done in the market have been on shorter duration assets. So, auto loans are typically a 7-year at most pool. If you look at things like sublines, even if you account for some revolving features of them, they tend to be 3-year assets. So that's why I think you see, have people done longer ones? Sure, they have. But from the bank's perspective, there's more complexity because it then is managing its strategy 25 years into the future. And so that can be more difficult. And I think banks, when they're trying to pick and they say, where I have, a pool of auto loans and a pool of resi mortgages, and both have this mispricing in terms of their required capital risk weight, I'll do the auto because I can manage that 7-year risk better.
So is it a product which is designed just for sophisticated investors and banks with some level of sophistication, to tackle all this?
It is for sophisticated investors. This certainly is not something that you or I will ever be investing in,
right?
Even though you're probably a pretty sophisticated investor with your experience. But it is for sophisticated investors, your major asset managers, your insurance companies, your major pension plans. Again, we aren't talking about, huge pools of retail money flowing into this space. So on the investor side, it is pretty sophisticated because you want people to understand, hey, I'm taking a first loss position on a pool of real estate loans in Indiana. Like that's a pretty unique risk there that you would expect investors to need a high level of sophistication. On the bank side, I don't think you need to be as sophisticated because you're fitting within the capital rule framework and you're dealing with assets that are already on your balance sheet. And so is there a point of diminishing returns where, the bank is so small that even if it knew how to do one of these things, it wouldn't be worth it from the size of the pool? Yeah, I tend to think that once you get below like $10 billion in assets, there are fewer banks who this benefits. I'd say most banks over 50 billion could benefit from it, and there are relatively few banks under 10 billion who could benefit.
Right. And
who are the investors primarily in this? Are they funds with credit risk transfer divisions, or who are? You don't have to name names, but just what's the who do you see in that market?
They tend to be fairly sophisticated asset managers with funds and other similar fund-like products who have a focus in asset-backed instruments. So, if you're a big investor in RMBS, if you're a big investor in CMBS, if you're a big investor in auto finance securitizations, that this fits nicely into your strategy. Also, if you're an opportunistic investor, if you have an alternatives desk and you are trying to I'll say chase yield, that where else are you going to find an instrument paying 1,500 basis points?
Yeah, right. So, but for the banks, even after paying 1,500, it still makes sense, you think, for their they get that much regulatory capital saving out of it?
They get that much regulatory capital. So yes, that makes sense. But also think about it from the bank's perspective. Let's say you have a pool of commercial real estate loans that are paying SOFR plus 900. Not outrageous. That's a reasonable for commercial real estate. And let's just, again, keep the math simple, say it's $1 billion. So, and we'll say it's amortizing, even though we know it's not, just again, because I need simple math. I'm a lawyer. I used to be an accountant, but I am a lawyer. And so we'll say on that billion, we're paying 90 million a year in interest,
Right.
is what the bank is receiving. On a risk transfer, the bank is selling the first 15% loss. So that is, the bank is selling loss on 150 million of that pool.
Right.
And let's say it's, again, selling it at that 1,500 basis point risk.
Right.
That means the bank is paying 22 million a year for that protection. So the bank is still getting the 90 million a year in interest, and on a like a net basis, it's getting about 65 million that it gets to keep. So it still is getting interest on those loans, plus it's freed up all that capital. So yeah, it still is worth it.
Oh, that's a lot of saving. Yeah, I didn't. That's amazing. And like there was one more point when we first talked was when the U.S. Regulators clarified rules on using credit risk transfers, right? And before that, the deals were happening, or banks were doing these trades, but they were not doing as much. But after the clarification of the rules, there seemed to be hope that there is going to be a lot of volume. We saw a string of deals, and I think there's still a lot of deals going on. Could you take us to, or could you tell us what was this clarification, and where are we going now with this with these opening up of the markets? Because I guess Europe is very busy. Like Europe does it regularly, but the US was always not embracing the product as much.
Yeah. So one of the difficulties in the U.S. market is that under the capital rules, there are three basic paths to credit risk transfer. One is for the bank to collateralize that first loss exposure. The other is for the bank to engage in a funded credit default swap. So again, collateralizing the exposure. And then the third is for the bank to find a really high quality protection provider like another bank and get an unfunded credit default swap. And on that first part of financial collateral, you kind of sit there and scratch your head and you're like, okay, how is a bank supposed to collateralize a loan with money that doesn't come from the borrower? That like there's not really an elegant way to say Shankar is going to collateralize Matt's mortgage.
Right.
And so we had developed a technology where a bank would issue a debt security, and like when you issue debt security, the bank sells the security to Shankar. It takes money in, and that's how a debt security works. And so that the bank was taking your money as protection coverage for my mortgage, but it was actually taking your money. It was selling you a debt security. And the capital rules talk about a collateral interest. And so you kind of have this mismatch of when you take proceeds from the sale of debt, that's ownership of the money, that isn't a collateral interest in the money. And the regulators just could not get over that. And so that's why a couple of years ago, they issued this FAQ saying, look, even though the proceeds from a debt security sale are not the same as a collateral interest in money, that, it's close enough, or I would say it's better than, because you actually own it. And so they said, we'll allow you to treat these sales of debt that protect a pool of loans as a risk transfer and give capital relief.
Right. But it kind of talked about not involving insurance companies insuring. And is it part of the subprime crisis routine where there were monoline insurers backing and they backed out?
Yeah. So the capital rules, they say no monoline insurers because the U.S. regulators, have concerns about that still. I think they're unfounded, but they have concerns. What they say is that a protection provider has to have issued debt that is investment grade. And so and they can't be a monoline insurer. And that has two really weird problems to it. The first is that in the insurance world, debt is issued by the holding company, the parent company. So like insurance companies are complex groups where there's like a holding company, and then there's lots of different insurance companies that, write auto insurance, property and casualty insurance, and all that stuff. And the debt is issued by the top tier holding company, not the little insurance companies. And so that creates a mismatch that the capital rules say the protection provider has to have investment grade debt. Yet, as an industry practice, insurance companies themselves don't issue debt. It's only their holding companies. So that's one problem. The second problem is in New York, we have this insurance rule that says only a monoline insurer can write financial guarantee insurance. And a financial guarantee provided by an insurance company looks a lot like financial guarantee insurance. And many insurance companies do business in New York. And so you have this mismatch of the capital rules are saying you can't be a monoline insurer if you want to write financial guarantee insurance to a bank. And New York is saying you must be a monoline insurer if you want to write financial guarantee insurance. And so you kind of have this conflict of laws. And so that's why we've had this problem with banks not being able, for the most part, to buy risk transfer protection from insurance companies in the US, at least.
So is that going to change, you think? Because that will unlock a lot of liquidity to this market, I guess, right? Is that something people are lobbying for, or
we certainly have been advocating for it. Some of the comment letters we worked on advocated for it on the capital proposal. I think some things we might get relief on, like the whole parent company debt thing, because that's just a silly artifact. Right. How we square New York insurance law and federal bank capital regulation, that I'm hopeful we can fix it, but that's again a tough one.
So, and one of the things, Matt, like when everyone started talking about credit risk transfer, the size of the deals or the size of collateral which were sold risk on, there were a lot of opposition, right, from lawmakers, or there were some economists or researchers talking about how hard it is to know how much of loss the banks have sold. You can't find them on balance sheets. They're so private. What's going on? What is your view on all that? Like, do you think all these alarms being raised make sense, or?
I think it's a bit overdone. That, look, there's lots of things on a bank balance sheet that people don't know about. Like, do you know the loan to value ratios for collateral on a bank balance sheet? I remember I was talking with a bank treasurer, and I was like, hey, buddy, you've got a ton of commercial real estate on your book. Shouldn't you want to do a risk transfer? And he's like, Matt, the blended LTV of that is 21%. Why would I view this as a risk that I need to move off with that? And I'm like, oh, well, yeah, that's a good point. As a reader of your financial statements, I can't really see your LTVs. And so, if we're not putting that data out there, then I really don't know why we have to put out the data on these actual risk transfer transactions.
Right. But is the size of the market really big to be concerned, though? How much of risk has been sold, you think? Estimate, because there is no
in the US, it's typically around 50 billion a year, I think, is the amount of assets being covered by protection, which in a market where we're talking about banks having upwards of 15 billion in assets, or trillion, sorry, 15 trillion. That's a tiny segment. And for the most part, the US market has been fully funded. So the banks know the protection will be there when they get there, that it's not like 2008 where you're making margin calls or receiving margin calls and that kind of thing. So it's on a funded basis. So I'm not really worried about that size or funding structure.
And so one of the concerns is that an investor will buy a portion of risk from one deal, take a portion of risk from another deal, and then collateralize it and sell it to someone else. Do you see Is that a possibility? Do you think that will happen?
It is a possibility, yes.
Right.
And it's part of how the economy works that, I can go to my retail broker dealer and get a margin loan on my securities portfolio. I like an insurance company can go out and invest my premiums in a wide range of assets.
Right.
You have the entire fund finance industry that is built on either collateralizing against pools of investors or net asset value. So like, yeah, this is a way that financing has been done of pooling
For
risk,
forever, yeah.
and so that's why I don't really see that much harm from a risk transfer investor going out there and getting an appropriate amount of leverage from a
Right.
financing provider who knows what they're financing.
But you see, like when they immediately start thinking about the crisis, and some of it was caused or by all this kind of repackaging or resecuritization, as they call it. Do you see that as a cause of worry? Do you see, because I almost had, when I was looking into credit risk transfers, I thought it was almost impossible to put together securities from different deals. The reason, because every bank risk which you're taking on has a different way of valuing the loans. So it is very hard to put together different valuations in one portfolio, I guess.
That's typically done on the front end of things when you're negotiating like the interest rate on it. So
Right.
the 200 basis points versus 1500, that's like a significant part of the valuation process.
Okay.
And like I said to your colleague at the beginning, like banks aren't intending these things to be regularly trading where, look, they're marked to market, but they're still not regularly trading where you're going to have to be constantly
Right.
assessing the credit quality of the ultimate underlying reference assets.
Right. 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 So if they're not trading, it's very hard to get your hands on all of them, yeah, or to
Yes.
create a pool, I guess, yeah.
Yes. Yeah.
Yeah.
And generally, more broadly speaking, Matt, I wanted to understand. So, like now we are talking about AI, right? AI
Yep.
leverage building. Everyone is talking about it. Do you see banks using this particular tool to sell some of the risk with these AI deals? Because they are high quality, many of them, but they are like they also are getting expensive to do in different places, and I think the valuations are changing on these trades. How do you are you seeing a lot of people talking about you know selling AI risk into these markets?
And the primary area that I'm hearing it is data center securitizations, because
Right.
that's just another form of commercial real estate securitization.
Right.
Now, some of these are being done as true securitizations because these loans are recently made, so that you can actually do the balance sheet. Like you can do a true sale without taking a huge mark to market loss. You also could do a synthetic risk transfer on them.
Right.
So I'm hearing that kind of conversation on both, again, the cash and the synthetic sides of the market.
So it kind of opens up another funding source almost, right? You
Yes.
would think. So this is another broader question I had. Due diligence in these markets. I've like there are the pages of
Mhm.
documents on everything. How are people going to be able to read all of that and make a judgment? Do you think people have stopped reading documents and they rely on rating agencies to do their work, or internal credit assessment guys to do their work?
I certainly hope not. That I am a proponent to people of make sure you know what you're buying. That if you are an investor in RMBS, maybe you shouldn't be playing in the auto risk transfer market. Um, and for the most part, I think investors have stuck to that of, I trade this in, I invest in this asset class in the cash market. I'm going to apply that knowledge to the synthetic market. And that's really how I think you can make your due diligence efficient, because then you're just applying the same techniques you use in your earlier deals or for the majority of your book to this different deal structure.
Right, right. So there is some sense to the crazy buying of bonds based on yields. Yeah.
Yes, there is some sense to it. Yes.
Yeah. Hey, Matt. On a personal level, is what you're doing? Would you consider it a growth industry? And we always ask guests this at the end of toward the end of the podcast. What advice would you give to incoming law students or people interested in the credit markets? Where would you point them?
So I don't think this area specifically of credit risk transfer is a particular growth area in the legal sense that there's already people like myself and others who do it, and the market has grown to a pretty significant size, like we were saying, like 50 billion a year. So I think that those aspects are maybe at their natural growth end. What I would encourage people, law students and others who are younger in the market, is to find something that you can be really good, the expert at. That part of the value I bring is that I know this incredibly detailed area of law on regulatory capital. And I don't think everyone needs to know it. Certainly wouldn't be efficient for everyone to know it. But there are other places, the insurance capital rules are similarly arcane, and I don't understand those. And there are other people who do, and I think that's a growth area. There are places in how you treat structured products, like structured deposit products, and being able to show that I have become an expert in this particular area of the market, that makes you valuable to an employer. And so that's what I would encourage.
Right. So specialization over anything else.
Yeah, AI is going to make generalists a much more competitive market. That if AI can do 100 things 80% as good as a human, and that's going to be really hard for a generalist to compete with.
Right. So AI proof yourself essentially.
Yeah. Yes.
with specialty.
So how do you get about to the specialization you do? Is there a way? Is there a path towards it, or how do you learn bank regulatory stuff?
Yeah. So I think that it's getting harder because there are fewer banks, there are fewer law firms who do this. For a lot of people, it means going into the government for the right amount of time. That at some point, people in the government, just culturally, they're not as attuned to the private sector, and so it's really going in for that sweet spot of 5 or 7 years, and then going into a more profit-oriented exercise like consulting or law. And so you got that training from your time in the government, plus then you haven't lost your drive for profit.
Right. Okay. So I think that's all we have time for, Matt. Thank you very much for all this.
Thanks, Matt.
Thank you very much. That was amazing. And thank you all for listening to us. Subscribe to Credit Matters on YouTube, Spotify, Apple, or wherever you get your podcasts. And tune in next week when we dig into more credit events. If you want to receive real-time reports, market data, you can request a free trial of IGM services. And thank you again. Thank you, Matt. Have a wonderful weekend.
Thanks, Matt.
Thank you, sir. Thank you.
Thank you both. Bye.
Good weekend.